Right now, the Indian economy is staring down a massive structural puzzle. I mean, if you just skim the headlines, you see a nation scaling its manufacturing at warp speed, right? Grabbing all this global attention. But scratch beneath that shiny surface, and there's this incredibly complex trade dualism putting immense, relentless pressure on the nation's balance of payments. Welcome to The Explainer. Let's figure out what's really going on here.
So, you're probably asking yourself, how on earth does a booming economy end up with a record trade deficit? It kind of breaks the rules, right? Historically, if you look at the East Asian model, rapid industrialization usually meant shedding reliance on foreign inputs pretty quickly. But for India, the current manufacturing boom is actually triggering a parallel explosion in imports. Literally, the faster the domestic economy hits the gas pedal, the bigger the national import bill gets. To really wrap our heads around the scale of this, we need to talk about $112.16 billion. That's India's all-time high trade deficit for the 2025-26 fiscal year, with just one single country, China. Now sure, India's total merchandise trade deficit blew past $280 billion. But that $112 billion gap with Beijing alone? That's a 154% jump in just 5 years. We're not talking about a small leak in the boat here. This is a structural flood.
To diagnose what's happening, we've broken this down into 6 parts. First, the growth and deficit paradox. Then, the Tri-5 vulnerability, followed by the China conundrum. After that, we'll hit currency, inflation, and jobs, look at the PLI policy prescription, and finally, chart a path to achieving true self-reliance. Let's jump straight in.
Starting with Part 1, the growth and deficit paradox.
Here's the invisible catch of modern manufacturing. To build and export things like cutting-edge smartphones or complex chemicals, India actually has to import the crucial core components first. Economists call this import intensity. Basically, as India plugs itself into the global production network, the very act of exporting requires this massive, continuous influx of foreign intermediate goods. So naturally, when that export graph shoots up, it completely drags the import graph right up with it.
Moving on to Part 2, the Tri-5 vulnerability.
This brings us to a really critical diagnosis of India's external trade strain, a completely non-negotiable dependency known as the Tri-5 vulnerability: fuel, fertilizers, and food. Because demand for these is highly price inelastic, any geopolitical shock, say trouble in the Strait of Hormuz, forces India's import bill to just absolutely balloon, totally regardless of whatever domestic policies are in place. I mean, India imports 85 to 90% of its crude oil, about 35% of its chemical fertilizers, and nearly 60% of its edible vegetable oils. Because a functioning economy literally cannot survive without these, any global price spike instantly creates domestic financial pain.
And that really puts things into perspective when you break down the import budget. Mineral fuels alone chew up over 28% of it. Add in precious metals, electronics, and machinery, and it hits you. The vast majority of India's import bill isn't exactly luxury consumer goods. No, these are absolute bare-bone essentials required just to keep the lights on and the factory floors humming.
All right, on to Part 3, the China conundrum.
This exposes a deeply asymmetric supply chain dependency on India's largest trading partner. And look, we aren't just talking about cheap consumer plastics here. Over 66% of imports from China are hardcore industrial components. We're talking the lifeblood required to run India's own factories, telecom networks, and pharmaceutical plants. Take pharma. India is a global heavyweight, right? But it still relies on China for over 70% of its raw active pharmaceutical ingredients. It's an incredibly deep structural reliance on intermediate parts.
Research from the Institute for Studies in Industrial Development essentially confirms this. While having access to these foreign inputs absolutely boosts India's export game, it simultaneously internationalizes the production process and massively deepens external reliance. It's the ultimate double-edged sword. Cheaper, high-tech foreign inputs allow Indian factories to make world-class goods, but they also inextricably chain the success of Indian manufacturing to foreign supply chains.
Let's hit Part 4, currency, inflation, and jobs.
So how do all these massive, abstract macroeconomic imbalances actually hit your daily life? Well, imagine the domino effect. A shipping bottleneck happens thousands of miles away. Suddenly, oil gets expensive. There's a huge demand for dollars to buy that oil, and the rupee drops to 96 against the dollar. Boom! That directly hits your wallet. Petrol goes up by 3 rupees. Milk gets more expensive, wholesale inflation climbs, and when households inevitably tighten their belts and stop spending, small and medium businesses feel the squeeze, which ultimately drives up national unemployment. It's all connected.
And the pain doesn't stop there.
Because India has to buy these inelastic imports, a falling rupee doesn't slow down purchasing like textbook economics might tell you. Instead, it just makes those necessary imports way more expensive, which totally spooks foreign investors. We're talking $50 billion withdrawn by foreign portfolio investors over just 18 months. It creates this brutal feedback loop. A weaker currency causes capital to flee, which, you guessed it, weakens the currency even further.
Which brings us to Part 5, the PLI policy prescription.
Recognizing these very real threats, the government went on the offensive with protective tariffs and a massive domestic manufacturing stimulus called the Production-Linked Incentive Scheme, or PLI. But here's the catch-22. While PLI is scoring massive wins in final product assembly, like smartphones and MRIs, even hitting 60% import substitution in telecom, it hasn't cracked the code on foreign component dependency. The tariffs designed to protect local industries are actually making those essential imported microchips and chemical compounds wildly expensive, actively hurting downstream exporters.
That being said, we absolutely cannot ignore the victories here. The policy has scaled domestic mobile phone production volume by an unbelievable 28-fold in just a decade. Jumping from 18,000 crore to 545,000 crore, that is a monumental shift in the industrial landscape. The sheer volume is definitely there. The next frontier, though, is increasing the actual local value within all that output.
Finally, Part 6, Achieving True Self-Reliance.
So what's the cure? Trade experts say India has to transition from a fragile assembly hub to a truly resilient powerhouse. How? First, rationalize those upstream tariffs to give exporters some breathing room. Second, and this is wild, recycle some of the 30,000 tons of domestically held gold to relieve the rupee from an $84 billion import drain. Third, move farmers to direct cash transfers to optimize fertilizer use. But the real game changer? Deepening PLI incentives to actually fabricate microchips and APIs at home, while strictly tapping supply dependencies on any single foreign country to 30%.
Financial leaders like Uday Kotak really hit the nail on the head here. Overcoming these deep vulnerabilities requires a massive pivot toward domestic research, development, and long-term risk capital. True self-reliance isn't about building a wall and blocking out the world, it's about building a powerful internal engine, technologically and financially, so you aren't completely at the mercy of external supply chains and foreign capital whims.
So I want to leave you with this final thought about the future of the Indian economy. Are the current policies genuinely building a robust, independent manufacturing ecosystem from the ground up? Or are we simply relocating the final stages of the global assembly line? The answer to that question is ultimately going to determine whether India can truly conquer its trade deficit paradox. Thanks for joining us on this explainer. Catch you next time.